Hello everyone, and welcome again to Nettle, the best platform around for distance learning in business, finance, economics, and much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. Many thanks to our current Patreon supporters for making this video possible, and we would also greatly appreciate if you consider supporting us as well, so please check the link in the description for more details. My name is Seva, and today we're investigating and trying to wrap our head around a relatively new yet still very important concept in liquidity risk measurement and regulation that is imposed by Basel Committee on Banking Supervision, the Net Stable Funding Ratio, or NSFR for short. This is just being slowly phased out currently as of 2021, but it has been hinted towards NSFR being one of the most important ratios that banks are required to calculate and support ever since the early days of Basel III development after the global financial crisis of 2007-2008. However, the systemically important financial institutions, such as our today's hero Barclays, are only starting to use this ratio from this year, from June 2021, in case of Barclays. So what the net stable funding ratio is all about, what is its logic, and how to calculate it as an outsider from a bank that has no access to internal banking data, to disaggregated data on banks' assets and liabilities, and how to calculate NSFR using reliable proxies. To assist me in today's tutorial, I heavily use the methodology provided by Basel Committee for Banking Supervision itself, and also by this European Central Bank discussion paper by Horova et al. That goes through a lot of various proxies that you can use to reliably match your NSFR calculations with the regulations in place that banks themselves use or will use or are expected to use starting in 2021. So without further ado, what is the logic of net stable funding ratio? Well, unlike the liquidity coverage ratio that is designed to protect the banks against short-term liquidity stress and bank runs, for example, the net stable funding ratio is a completely different beast. It tries to check whether banks have enough available stable funding in place to match their so-called encumbered assets that generate the requirement for such stable funding. Many banks have encumbered assets, that is, assets that mature quite in a long time, and they need to guarantee to match these assets by stable funding, which is reliable, it won't be withdrawn from a bank, and that is of considerably high maturity. The net stable funding ratio then protects the financial system by discouraging the banks from undertaking excessive maturity transformations when all banks' assets would be very short-term and very unstable, and banks' assets would be quite long-term with high maturity, and thus subjecting the bank, its customers, and as the banks that are subject to this regulation are systemically important, the whole financial system, to unnecessary liquidity risk. And as many ratios alongside this Basel tradition, starting from early credit risk ratios to more modern liquidity coverage ratio, NSFR also uses various haircuts, weights, and proxies to try and reveal more information from the bank's balance sheet and from various categories of assets and liabilities banks hold. So let's start with the required stable funding. What sources of required stable funding there are? What assets Basel considers relatively encumbered so that there should be long-term liabilities stable funding in place to provide for them? Well, let's start with assets that banks can hold without any considerations for their required stable funding. Those are obviously cash and settlement balances, which are most frequently coded as cash collateral and settlement balances in banks' disclosure. Those specifically are singled out by Basel methodology to not count towards the required stable funding because it's expected that those assets will be settled in the future without any uncertainty or any such considerations. Then there is a throwback to liquidity coverage ratio where high-quality liquid asset categories 2A and 2B are considered not that much encumbered to warrant so much stable funding as other sources of assets. And here, level 2A assets, which are basically high quality debt instruments, government and corporate bonds, go into required stable funding with a weight of 15%. And level 2B assets, which are basically high quality equity instruments, stocks of blue chip companies, basically, go into the required stable funding with a weight of 0.5, 50%. And the calculations of those categories, level 2A assets, level 2B assets, were covered in a lot of detail in our previous video on the liquidity coverage ratio, so please check this out if you're interested in that. Then, returning to more usual, more mundane classifications of assets, you have got varying weights for lending categories of various maturities. So mortgages are considered to be relatively less demanding of stable funding, relatively less encumbered than other types of assets because there is less optionality involved, and they are generally considered more stable of an asset. That's why mortgages of less than 1 year maturity are weighted with a weight of 50%, and longer term mortgages of a maturity higher than 1 year are weighted at 65%. While household loans, those are credit card loans, consumer credit, and so on and so forth, and commercial loans, which are basically wholesale loans to non-financial corporations, are weighted at 50% and 85% respectively for short-term maturities and longer-term maturities as well. And here you might ask, well, how do you get these items from your bank's publicly available disclosure? Well, these are simple. Those can be obtained from the contractual maturity of financial assets and liabilities section of your bank's disclosure. Sometimes it's also referred to as maturity analysis of assets and liabilities. So this is quite straightforward. And to get these down the line, you need to make some reasonable, yet not entirely obvious assumptions about the structure of maturities and customers of in terms of banks' lending mix. And here, let's touch upon that. So first of all, we have got here, straight out of the contractual maturity of assets and liabilities disclosure item, the maturity breakdown of loans and advances to customers overall. And we can see that Barclays reports it in quite standard maturity brackets, and what we are interested in here are just maturity brackets up to 1 year and 1 year and over. And here we can calculate the total amount of loans and advances up to 1 year in maturity and greater than 1 year in maturity. And we can see quite obviously that's quite typical of banking business model in general. Longer term loans account for 84% of total loans, meaning that banks generally borrow short term and lend long term. This is the source of their liquidity risk in general, and that is what NSFR tries to mitigate slightly, tries to put restraints on it, so that banks at least provide stable funding to account for their encumbered longer-term assets. And here we assume that all categories of assets are mortgages, consumer credit, and wholesale, a commercial credit to non-financial corporations, is characterized by such a maturity structure. How to figure out the client breakdown of banks' lending? Well, here the risk performance section of their annual report could be useful, and sometimes it's just called credit risk, sometimes it's a whole section on risk performance, with credit risk being a separate section. And there, for credit risk purposes, banks disclose who actually they lend to. And there you would most likely see three categories. Here we have got mortgages, which are classified there as home loans, household loans that are not mortgages, which are basically credit cards and other retail loans, consumer loans in general, and commercial wholesale loans. And those are the three categories we're interested in for our required stable funding calculations. So here we can calculate the percentages of a particular item from this breakdown in terms of the total loans and advances, and we can see that almost a half of Barclays lending is mortgages, which is quite typical for a large traditional bank, with its mortgage portfolio being a substantial source of its interest income. No surprises here, really. So here we can actually account for the structure in terms of clients and in terms of maturity to calculate every single one of these items. For example, to calculate mortgages that mature in less than a year time, we can multiply the total value of loans and advances in terms of home loans onto the percentage of total loans that mature in less than a year. Again, here we implicitly assume that all types of lending have the same maturity structure, which can be considered unrealistic, as mortgages are more long-term than other types of loans traditionally. That's not as of an unrealistic assumption to worry about it too much. And here we can calculate mortgages that mature in more than 1 year by the same token, and do the same for other two categories of lending. And then what is actually quite stringent about NSFR in general and required stable funding in particular is that all other assets that don't go into these categories have a weight of 1. They are considered encumbered unless proven otherwise. So it means that we can just get the total assets figure from the same maturity breakdown, or just from the balance sheet actually, and subtract all of the assets we have considered with other weights to get the other assets category that is considered encumbered and should be backed up by available stable funding. And we see here that Barclays has roughly $750 billion in required stable funding. So they have to, from June 2021 at least, to have at least that much in available stable funding. So what is considered stable funding? Well, first of all, and that's quite straightforward, bank capital. And it goes in with a weight of 1 because it's the stablest funding you can possibly imagine. However, there are also other disclosure items that go into available stable funding with a weight of 1, which are various sources of debt with a maturity of greater than 1 year, as well as household and commercial deposits with a maturity of over 1 year. Notably, and it's quite similar to the liquidity coverage ratio calculations, financial deposits, that are deposits from financial institutions and other banks in general, are going there with a weight of 0. Deposits by financial institutions are not considered stable because those could be withdrawing their funds at any time to satisfy their own liquidity needs. And also we have got less stable funding categories that are generally just categories of less than a year. So, for example, commercial deposits go there with a factor of 0.9, meaning that they are quite less stable than longer term deposits from non-financial corporations, while household deposits with maturity less than a year go in with a weight of 0.95. And this reflects two sources of stability that Basel considers important. The maturity-related aspect of stability, something that is longer term in terms of funding, is more stable, and behavioral stability, which is basically the fact that non-financial corporations are, all other things held equal, more likely to withdraw their deposits than household customers. And that is why this weight is higher than that weight, due to behavioral reasons that single out household depositors from commercial depositors. And that's exactly why financial deposits, no matter what the maturity, are considered absolutely unstable, simply because behaviorally the financial counterparties are quite opportunistic and they would withdraw their funds at any time to satisfy their own liquidity needs. The less stable funding is other sources of debt that do not originate from financial counterparties. Again, behavioral stability plays a key role here, of less than a year maturity. So how to proxy it using banks' publicly available disclosure? Well, first of all, in terms of deposits, we can figure out what is the financial deposits by breaking down loans, advances, and deposits at amortized cost by customer group. And there, the banks would quite funnily report loans and advances and deposits from banks and from customers, implying that banks are a whole separate group of customers, meaning that banks themselves distinguish this behavioral category of stability, quite funnily. So this goes in with a weight of 0, and all other deposits, meaning that we need to get deposits from the same old contractual maturity of assets and liabilities section. We get these total deposits and simply subtract those financial deposits coming from, again, loans, advances, and deposits at amortized costs, and get the deposits of non-financial corporations and households. And we need to break them down somehow, and that's a similar procedure we did for liquidity coverage ratio calculations. So what we can do to determine the structure of deposits between non-financial corporations and individuals or households is to extrapolate it from the UK structure, as Barclays reports it for the UK department, but does not report it across the whole group. And here, what we can do is we can assume that the ratio of business deposits or corporate deposits to total deposits is the same for all departments. And it's not that realistic of an assumption, given that personal banking business of Barclays is more prevalent in the UK perhaps, and commercial business is relatively more prevalent in the US, the other major international destination of Barclays. But still, it's again not as of an unrealistic assumption to warrant other calculations. So here we see that in the UK, business deposits account for just 22.5% of total deposits. Extrapolating to the group, we can see that here business deposits would make roughly £90 billion, and personal deposits by extension roughly 310 billion. And then we can retrieve the maturity structure of total deposits from, again, contractual maturity of assets and liabilities. Here again, we're just interested in deposits that mature in less than a year and more than a year. Here, evidence of maturity transformation is quite striking. Almost all deposits are maturing in less than a year, 98.44% to be precise. So here we can make another assumption that deposits across various customer groups are the same in terms of their maturity structure, and just multiply the amount of personal household deposits onto the share of total deposits that mature in less than a year, so 98.44% over here, and proceed with this analysis throughout. In terms of stable funding and less stable funding, we need to look at other items of the disclosure at the same contractual maturity of assets and liabilities page, and get the items that include repo, repurchase agreements, and secured funding, debt securities, subordinated debt, trading liabilities, and financial liabilities. Here there is a little twist. As repurchase agreements are mainly in place between banks and different financial institutions at both sides of the transaction, it is considered quite unstable to have those with less than a year maturity. So those, up until 12 months, get completely discarded. They don't go in even with a weight of 0.5, as other less stable funding would. However, longer-term secured funding from this category would go in with a weight of 1, so it's genuine, stable funding that is as stable as anything else. While other 4 items over here would have the usual and perhaps more easily understandable breakdown, with longer term funding across these lines being weighted at 1, and less stable funding of less than a year maturity would have a weight of 0.5. And here we account for that by summing up less stable funding times 0.5 across these 4 categories, and stable funding across all 5 categories, but with a maturity of more than a year. And this is all about the required stable funding and available stable funding. We can calculate those by just using the sum product function across the disclosure items and respective weights. So here it is for the required stable funding, and here it is for the available. And finally, we can calculate the hero of our today's tutorial, the net stable funding ratio, or NSFR, which is a ratio between the available stable funding and the stable funding required. And obviously, Basel wants banks to have this ratio at least 1 for them to be able to provide for their encumbered assets with their stable funding at least pound for pound. However, calculating it for Barclays using now proxies, we see that the net stable funding ratio estimate for Barclays is lower than 1. It's approximately 90%, meaning that if Barclays was subject to NSFR regulations as of now, it would not satisfy those. And it is unsurprising given first the fact that it's not currently in place, this bit of regulation, and second, how stringent our approach to proxies is. First of all, we just disregard all other assets and bulk them into the group that has a weight of 1, while perhaps if we had more disaggregated data, this figure over here would have been quite lower, and some bits of these assets would go into brackets with less weights. So this is potential origin of some bias in this figure, some downward bias in this figure, if we're talking about NSFR. However, it's quite consistent with the findings of Hoerov et al. That report that average net stable funding ratio across a large set of European banks they were surveying is less than 1. It's around 95%. And it's actually not that surprising because, well, Basel is not yet asking banks to comply with this regulation, and that's why banks do not generally. So it means that such regulation could be needed to push banks above 1 in terms of their net stable funding ratio. To draw some comparisons, we can also look at the estimation for 2018, where we do the same calculations for disclosure items from the Barclays 2018 annual report, and we also achieve a net stable funding ratio of less than 1. However, here it's around 91%, which is substantially higher than the one at 2019, meaning that Barclays is not even moving towards this sweet spot of 1 that would have satisfied NSFR regulations if they were in place right now, signifying potentially that either there are some liquidity issues at Barclays in terms of available stable funding that provides for encumbered assets, and this is unsurprising if we look at this maturity breakdown that could have been identified using a simple maturity mismatch model, I guess. But also, it should be taken with a pinch of salt, given that this proxy approach is quite restrictive, potentially, and particularly on the required stable funding side. And that's all there is for the net stable funding ratio and how to calculate it using publicly available data from your favorite bank's disclosure. Please leave a like on this video if you found it helpful. In the comments below, I'm eager to see any further suggestions for videos in business, economics, or finance topics you would like me to record. And don't forget to subscribe to our channel or consider supporting us on Patreon. Thank you very much, and stay tuned.